You're stuck. You've got 50,000, but you don't know how to make it work for you. Every day you wait, you lose money. Stop playing small. Today, we're putting JEPQ and SCHG head to head. One is a cash flow monster, the other a growth machine. Both crush the S&P 500, but here's the kicker. You don't have to choose just one. You can play both to dominate the market. Stick around and I'll show you why not understanding these ETFs is costing you thousands. Here's the cold hard truth. Most people lose money because they don't know where to put it. They stick with safe choices like the S&P 500 and wonder why they're still behind after 10 years. But you're smarter than that, and you've got options. Two options to be exact, JEPQ and SCHG. Both are obliterating the S&P 500, but they're doing it in radically different ways. Let's start with the numbers that matter. Over the last 3 years, JEPQ delivered a jaw-dropping 50.39 total return. SCHG not far behind with 41.46%. Compare that to the S&P 500 limping in at 26.41%, and it's clear these two ETFs are playing in a different league. Now let's zoom in on 2024. SCHG is the runaway leader in a bull market, up 38.34% year to date. That's insane, but don't sleep on JEPQ. It's up 26.69% in the same period while paying out massive dividends. How massive? Try 10.1% dividend yield. Compare that to SCHG's laughable 0.4% and you see the trade-off. SCHG is the hare sprinting ahead with growth. JEPQ is the tortoise stacking cash flow consistently year after year. The difference comes down to this. JEPQ is a cash flow machine. It thrives whether the market is going sideways or moderately up. SCHG, on the other hand, is built to dominate in full-blown bull markets, riding the wave of America's largest companies to incredible growth. It's like choosing between a high-octane sports car and a diesel truck. Both get the job done, but in completely different ways. Here's the part that should blow your mind. Owning both is the ultimate power move. With JEPQ, you get steady income, enough to reinvest, compound, or spend. With SCHG, you're setting yourself up for explosive long-term growth. Together, they cover all your bases, letting you win in any market condition. So the question isn't which ETF to choose. The question is, when are you going to stop wasting time and start making your money work harder? Let's talk about JEPQ. This isn't just another ETF. It's a cash printing machine built for investors who want income now. JEPQ's strategy isn't just smart, it's ruthless. It's designed to generate consistent cash flow no matter what the market's doing. And trust me, it delivers. Here's how it works. JEPQ invests in the biggest names in tech. Apple, Microsoft, Nvidia. The companies dominating the NASDAQ. But it doesn't stop there. It writes covered call options on those holdings. Translation, JEPQ is earning extra cash on top of stock performance. That's like your portfolio pulling double duty, growing in value and generating premium income. Now, let's talk results. JEPQ's 10.10% dividend yield is next level. For every $50,000 you invest, you're pocketing $5,050 a year just in dividends. That's not potential, that's actual cash hitting your account, and that's before we even factor in capital appreciation. Let's be honest, finding yields like this from a legit ETF is like stumbling on a unicorn in the wild. But, and this is a big but, there's a trade-off. JEPQ's covered call strategy caps its upside in a raging bull market. When tech stocks soar, the call options you write limit how much of that growth you capture. It's not a problem if you're after income, but if you're chasing maximum price appreciation, you might feel like you're leaving money on the table. That said, JEPQ thrives in markets where others falter. Sideways, no problem. Slightly up, still winning. Even during periods of high volatility, the premium income from options acts as a cushion against big swings. That's what makes JEPQ a powerhouse. It's engineered for reliability in a market that's anything but. The bottom line, if you want income you can count on, JEPQ isn't just good, it's the best. It's not flashy and it's not about explosive growth. But if you want to get paid while staying invested in the hottest sectors of the market, this ETF is a no-brainer. Stop chasing crumbs and start collecting real cash flow today. SCHG is the ETF for growth chasers. If you're tired of waiting years for mediocre returns, this fund is your rocket ship. It's built for one purpose, to grow your money faster than anything else in your portfolio. And in 2024, it's proving exactly why it's a leader. Let's start with what makes SCHG tick. This ETF tracks the Dow Jones U.S. Large Cap Growth Index. Translation, it's handpicking the most dominant U.S. companies across industries like tech, healthcare, and consumer goods. We're talking about household names: Apple, Microsoft, Amazon, Tesla, the giants that move markets. Here's what separates SCHG from the pack. It's uncapped. Unlike JEPQ, there's no ceiling on your growth. When the market's on fire, SCHG rides the wave all the way up. That's why it's up 38.34% year to date as of December 2024. Let me repeat that. 38.34%. That's not just a win, that's domination. If you're not paying attention, you're missing out on one of the most aggressive growth engines in the market. But, and this is important, SCHG isn't for everyone. Its dividend yield is just 0.4%. That's not a typo. This ETF isn't putting cash in your pocket every quarter. Instead, it's reinvesting back into the growth machine. If you're looking for steady income to pay bills or reinvest manually, SCHG is not your answer. But if you're playing the long game and want to see your portfolio explode in value, this is your weapon of choice. Another thing to love about SCHG, diversification. While tech is its bread and butter, it's not a one-trick pony. SCHG balances its holdings across multiple sectors to reduce risk. That means even if one sector stumbles, the ETF as a whole stays strong. You're getting all the upside with less of the roller coaster ride. The bottom line, SCHG isn't for the faint of heart. It's for investors who are ready to think bigger, take on some risk, and reap massive rewards. If you're okay with letting your money grow instead of pulling cash today, SCHG could be the smartest move you make this year and next. Let me hit you with a reality check. Picking one ETF is like trying to win a race with one leg tied behind your back. JEPQ and SCHG are built for different market conditions. One gives you income now, the other gives you explosive growth. If you're only holding one, I don't like leaving money on the table. Here's the deal. JEPQ is perfect for markets that are sideways or moderately up. It thrives by stacking premium income through covered call options. That means you're still making money even when everyone else is complaining about flat returns. It's your cash flow engine, a reliable source of income no matter what the market throws at you. Now let's talk about SCHG. This is your bull market beast. When the market's running hot, SCHG is the ETF sprinting ahead of the pack. There's no cap on its growth, so you're capturing all of the upside. That's why it's up 38.34% year to date in 2024. But don't expect it to pay the bills right now. It's all about long-term growth. Here's where the magic happens. You don't have to choose between them. You can own both and cover all your bases. JEPQ gives you consistent cash flow to reinvest, compound, or spend. SCHG gives you growth that compounds into serious wealth over time. Together, they're the ultimate one-two punch for your portfolio. Think of it like this. JEPQ is the foundation. It's steady, reliable, and pays you to hold it. SCHG is the rocket fuel. It's volatile, but it takes your portfolio to new heights. When you combine the two, you're setting yourself up to win no matter what the market does. Bull, bear, sideways, it doesn't matter. You're always playing offense. So here's the question. Why limit yourself? Stop trying to pick the perfect ETF. The smart money move is owning both. Diversify your strategy, maximize your returns, and dominate every market condition. That's how you build real wealth. JEPQ is like the Swiss Army knife of ETFs. It's versatile, efficient, and built for one purpose, putting cash in your pocket. But before you dive in head first, you need to understand the full picture. Every investment has its strengths and weaknesses, and JEPQ is no different. Let's break it down. The pros. Massive dividend yield. JEPQ's 10.10% dividend yield isn't just good, it's jaw-dropping. For every $50,000 you invest, you're earning $5,050 annually in passive income. That's like owning rental property without the tenants or maintenance headaches. It's real money you can reinvest, spend, or save. Income in all markets. Unlike growth forecast ETFs that rely on the market going up, JEPQ thrives in almost any market. Flat, you're still getting dividends. Slightly up, you're winning. Even in volatility, the covered call strategy cushions your portfolio by generating premium income. Tech-focused portfolio. JEPQ doesn't just invest in random companies. Its portfolio is stacked with the biggest names in technology. Apple, Microsoft, Nvidia, Meta. These companies are driving the economy forward, and you're along for the ride. Built-in risk management. The covered call strategy may cap your upside, but it also protects you during market downturns. While others are panicking, you're still cashing those dividends. Let's go over the cons. Capped growth. Here's the trade-off. When tech stocks explode, JEPQ's growth is limited. The covered call options cap your gains. If you're looking for maximum price appreciation, this might feel like a deal breaker. Tech concentration. While the tech focus is a strength, it's also a risk. If tech takes a nosedive, JEPQ will feel the impact more than a diversified ETF. JEPQ is not a long-term growth machine. Let's be honest, JEPQ isn't for investors chasing massive capital appreciation. It's for those who want income now, not a 10x return in 20 years. Bottom line, JEPQ is a cash flow powerhouse. If you need steady income or want to reinvest and compound aggressively, it's the ETF for you. But if you're chasing high growth potential, it's not going to scratch that itch. Know what you're buying and use it strategically. And SCHG, it's like a purebred racehorse. It's built to go fast and win big. But before you bet the farm on it, you need to understand both the highs and the trade-offs. Let's break down what makes SCHG the growth investor's best friend and why it might not work for everyone. The pros. Uncapped growth. SCHG doesn't play it safe. There's no ceiling on how much your investment can grow. If the market's running hot, SCHG is sprinting right alongside it, delivering massive gains. That's why it's up 38.34% year-to-date in 2024. It's built for aggressive growth. Diverse sector exposure. SCHG isn't just tech-heavy. Yes, tech is a key driver, but this ETF also includes healthcare, consumer goods, and other major sectors. This diversification reduces risk while keeping your portfolio positioned for big wins across multiple industries. And then there's top-tier holdings. SCHG is like an all-star team of America's biggest companies. Apple, Microsoft, Amazon, Tesla, the giants that dominate their markets. When these companies thrive, SCHG benefits directly. A proven track record. This isn't some experimental ETF. SCHG has consistently delivered strong returns over time. If you want reliability in the growth category, this is it. And now the cons. Pathetic dividend yield. Let's not sugarcoat it. SCHG's 0.4% dividend yield is practically non-existent. If you're looking for cash flow, this is not the ETF for you. You're reinvesting every penny into growth, whether you want to or not. A bull market reliance. SCHG shines when the market is booming, but when things slow down, it's not as reliable. If you're banking on steady returns in a volatile or flat market, SCHG might leave you hanging. And then we've got volatility risk. Growth-focused ETFs like SCHG come with higher volatility. Big gains also mean potential for big swings. If you can't stomach the roller coaster, this isn't your ride. So here's the bottom line. SCHG is a pure growth machine. It's for investors playing the long game, willing to trade cash flow today for massive gains tomorrow. If you're looking to build serious wealth and don't mind riding out the highs and the lows, SCHG is your best bet. But if you need steady income, keep looking. Know your goals and use SCHG strategically. Here's the question everyone asks. Which one should I buy, JEPQ or SCHG? Wrong question. The real question is, what's your plan? Because if you don't have a plan, it doesn't matter what you invest in. Let me break it down for you. If you're looking for immediate income, something you can reinvest, spend, or save, JEPQ is the obvious choice. Its 10.10% dividend yield means you're getting paid now. That's $5,050 a year on a $50,000 investment. For retirees, income investors, or anyone who wants steady cash flow, JEPQ delivers every time. But if your goal is long-term growth, building a portfolio that compounds into serious wealth, then SCHG is where you want to be. SCHG doesn't pay you today, but it sets you up to win big in the future. Its uncapped growth potential makes it a powerhouse in bull markets. Up 38.34% year-to-date, that's not luck. That's what happens when you invest in America's top-performing companies. Here's the trick. You don't have to choose one or the other. In fact, the smartest move is to own both. Why? Because JEPQ and SCHG complement each other. JEPQ gives you reliable cash flow that can stabilize your portfolio or fuel reinvestment. SCHG gives you the long-term growth that builds wealth over decades. Think about it like this. JEPQ is your safety net. It's steady, predictable, and pays you to hold it. SCHG is your growth driver. It's fast, aggressive, and focused on delivering big returns. Together, they're the ultimate investing duo. You're playing offense and defense at the same time. And here's the kicker. Timing matters. If you're close to retirement or need passive income, lean heavier into JEPQ. If you're younger or have time to ride out the market's ups and downs, prioritize SCHG. But no matter your age, owning both sets you up to win in any market condition. So stop wasting time trying to pick the perfect ETF. Use JEPQ and SCHG strategically. Invest with purpose, maximize your returns, and watch your portfolio thrive in any environment. Here's where things get real. You've got $50,000 and the clock's ticking. Every day that cash sits idle, inflation is eating away at it, and you're missing out on compounding growth. So what's the play? Simple. Split it between JEPQ and SCHG to build a portfolio that pays you now and sets you up for the future. Let's start with JEPQ. Put $25,000 into this cash flow beast and you're looking at $2,525 in annual dividends. No strings attached. That's real money hitting your account every quarter like clockwork. Reinvest it and you're accelerating your compounding. Spend it and you've got passive income to enjoy. Either way, JEPQ is the reliable income engine every portfolio needs. Now take the other $25,000 and park it in SCHG. This is your growth driver. With SCHG's 38.34% year-to-date return, that $25,000 could grow faster than anything else in your portfolio. Sure, there's no dividend payout, but that's the trade-off for uncapped growth. Over time, SCHG's compounding potential will outpace almost anything else in the market. Here's the magic. By combining these two ETFs, you're hedging against market uncertainty. Bull market, SCHG explodes in value. Sideways or slightly up, JEPQ keeps pumping out cash flow. Together, they're unstoppable. You're playing offense and defense at the same time, ensuring your portfolio thrives in almost any market condition. Do you want to supercharge this strategy? Reinvest every dollar JEPQ pays you back into SCHG. Now you've got income feeding growth, creating a compounding snowball that accelerates over time. It's simple math. The more you reinvest, the faster your portfolio grows. And let's be real, $50,000 today, reinvested smartly, could be worth a lot more than $50,000 tomorrow. But here's the thing, you've got to take action. Watching videos won't grow your portfolio. Thinking about investing won't build wealth. Only action moves the needle. JEPQ and SCHG are the tools. It's up to you to use them. Do you want more strategies like this? Join my Patreon for real-time alerts, top plays, and daily insights into the hottest moves in the market. The link's in the description. Don't wait for the perfect time to invest. The perfect time is right now. Peace, and I'll see you on the next video.